Welcome back, everybody. Today we're going to analyze Shopify. This is another one that is very popular among the retail crowd. So let's check it out. Over the past 5 years, they are up 230%. Um, they were up way more than that in the cloud market, but then they since crashed and then they've recovered from their low of like $26. Now they're all the way up to 70. So this is a highly volatile stock as it seems. And maybe there's a reason why. Maybe it's because it's a difficult company to value. I actually don't think it's that hard to value. Um, so we'll be going through that today. It is a $90 billion company, which is actually massive. Um, yeah, that's a huge company. They basically just set up like online marketplaces for people, or they like help regular people set up their own online shop. Not quite sure how big of a market there is for that, but 90 billion seems kind of insane. And their price to earnings ratio right now is 754, probably because their margins have been squeezed. Um, let's take a closer look at the financials here. They have had like extremely strong revenue growth, except for from 2021 into 2022. But then from 2022 into 2023, they actually reaccelerated some growth. And they actually did an acquisition. Pretty sure in 2022 they acquired a business or something, and so that could be the reason why their growth accelerated so much. But I'm not quite sure. Their gross profit is very, very consistent at around 50%, so that's a good sign, I think. And their operating expenses are pretty high. They do a lot of marketing and stuff, so they could definitely get this down a bit. But they also have to pay a lot of money to their developers. So they have done a lot of research and development. That really helps contribute to their growth. So it does seem like they're setting up for the future with their research and development, but it's also very costly. So hopefully they can reduce these costs because they're most likely not going to be able to improve their gross margin much, but they could definitely cut down on their advertising or their R&D expenses and get that net margin higher. Yeah, because with a gross profit of 50%, you could easily um, see a net margin probably around like 20 or 25% eventually for this business. On net income, yeah, like I said, they're pretty much reinvesting like everything straight back into the business, so they're not going to have much of a net margin. They also dilute shareholders. Most likely, this is just because of stock-based compensation. So they do quite a bit of stock-based compensation, and it shows up right here. Yeah, probably if they didn't do stock-based compensation, their net income would be negative. But yeah, I think stock-based compensation is pretty good because it really gives your employees an incentive to work and like um, do a good job for the company. So it's not a knock on stock-based compensation. Anyways, looking at their balance sheet, they have negative 3.8 billion in debt. So super, super good balance sheet. I mean, like extremely good balance sheet. Cash flow. What did they do with their financing? Well, they issued some stock and they issued some debt in 2020. That's about it. Otherwise, they do have pretty good, pretty good free cash flow in the last year. Yeah, really good free cash flow in the last year, almost 1 billion. That's actually much higher than I would think. It's different than their net income. Their net income was only 135 million. So yeah, I usually use net income because it's a little bit smoother a lot of times than cash flow. Cash flow can sometimes be all over the place. But also with net income, you always get some of these unusual expenses, which you always have to watch out for. So yeah, there's value in looking at the income statement and the cash flow statement. Sometimes you can pick out different things. Anyway, let's look at their ROIC. And their ROIC is not the greatest. Well, it depends really on their margin, most likely. Gross margin is very consistent though, right around 50%. And operating margin, yeah, operating margin's pretty much flat. Uh, I did look at some of their investor slides. Yeah, this one I pulled, they actually 103 million in one quarter, so they do like 400 million in stock-based compensation per year. Um, they might do like 500 million because they did 146 million last year in one quarter. And what else can we see here? Okay, this one as well. They make most of their money from merchant solutions. So that must be like one when somebody makes a sale, then um, Shopify takes a cut of it, and then they have some subscription revenue as well. So 525 million comes from subscriptions. I'm guessing that also has to do with people that sell using Shopify. They have a subscription to it as well, and so that shows up there. Both of these are going to rise with the amount of users that they have and the amount of stuff that they sell. They have much better margins on their subscription services than their merchant solutions as well. I can maybe find that. But yeah, this is another way of looking at it. Subscription solutions were 1.8 billion in 2023 and merchant solutions were 5.2 billion. And then you can see the cost, and the cost of the merchant solutions was about 60%, whereas the subscription services was what, like not even 20%, something like that. Um, but yeah, that's what contributes to their gross margin. And then they've got their sales and marketing, 1.2 billion they spent on that, and 1.7 billion on R&D. And then they had some like impairment from some acquisition. I'm not quite sure what that is, but yeah. Taking a look at this, this is Yahoo Finance on the stats page. We're taking a look at their short percentage, and it's only 2.3%. So that is a green flag there. Nothing to worry about. And then we've got their analysis tab. I always look at the earnings estimates here, 1.02 to 1.33. And then we've got 8.55 billion for revenue is what they're predicting for this year. And then next year, 10.27 billion, which is like a 20% increase into 2025. I put that stuff into the DCF model, so let's take a look at this. And so remember, Shopify had a very, very high price to earnings ratio. They also have a really high price to sales ratio at the current time. So that's why this is showing that they're currently overpriced. They would need more growth in order to justify their price at this time. Um, anyway, I put in the EPS estimate, the revenue estimate here, buybacks and net debt, as well as discount rate and an exit multiple of 20. I think 20 is fair for this business since I do think that they have a runway for growth for a while. But after what is this? After 7 years, they're not going to be growing nearly as fast as they are now, because they'll probably saturate the market at some point. So I have a earnings growth of 30%. That's what the analysts are predicting, and then 2020, which is still really high earnings growth, and just slightly falling from there down to 10%. And if this scenario plays out, then we're looking at $44 a share as a fair share price. Um, Usually with businesses like this that have such a small margin at the time, I rather use this revenue margins calculation. So the analysts are actually expecting like a 15% profit margin. So that is what I put here, and actually increasing from there because I do think that eventually they're going to be able to like cut some staff, maybe stop doing so much marketing, uh, stop doing so much R&D, and that will translate straight into the bottom line. So I think that they could get up to 25% margins. Now, in terms of growth, they're expecting 20% going into 2025, and I just have them declining slightly from there down to 8%. 8% is still strong growth. Okay, so don't get that twisted. That is still much higher than inflation. And if this scenario plays out, which I think is highly likely for Shopify, then we're looking at a fair share price of $47 a share. And yeah, so they are currently way overpriced. I'm definitely not adding this to my portfolio. Maybe it was a good buying opportunity when it was like 20 or 30 or like $26 a share or $30 a share. Uh, so, but I think you missed the boat on this one if you didn't get in, and I would not buy it at this price. If I bought it today, I'd probably be expecting, I don't know, maybe like 3% return, maybe. Yeah, probably like a 3% return if I bought it today. Of course, they could do better growth numbers than this. What do you guys think? Make sure to let me know in the comments what you think. Do you think that they can grow a lot more than this? Also, if you want, you can try it out for yourself. Try this spreadsheet. Um, there's a link in the description, and you can put your own growth numbers in here and see what you think it's worth. Yeah, anyway, leave a like, and I'll see you in the next video.